Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Today, we had the great pleasure to speak to Mark Yusko. Mark is the founder, CEO, and Chief Investment Officer of Morgan Creek Capital Management, a company that provides investment management services to institutions and wealthy families. Prior to forming Morgan Creek, Mark was the President, Chief Investment Officer, and founder of UNC Management Company, the Endowment Investment Office for the University of North Carolina at Chapel Hill. Prior to that, Mark was the Senior Investment Officer for the University of Notre Dame Investment Office, where he joined as an Assistant Investment Officer in October of 2003. I really enjoyed this conversation with Mark, and he was kind enough to give us a lot more time than we expected, so we decided that we would break this one down into two parts. Otherwise, it would get too long for you to be listening to the two of us speak about asset allocation, manager selection, and portfolio construction, which are topics that Mark really knows a lot about, and I'm sure you'll learn a lot from. But we also speak about what he thinks makes a great investor, why he spends so much time writing and putting his ideas down on paper and out in the world for everyone to see. We also talk about why he thinks institutions should think about including crypto assets in their diversified portfolio and many other topics. So I hope you enjoy it as much as I did. If you like it, please make sure to leave a 5-star review, as it really helps us grow the show. And without further ado, please enjoy our interview with Mark Yusko. So, Mark, thank you very much for agreeing to speak to us here at the Wall Street Lab. And I guess it would be great for those of us who don't know who you are to hear a bit more about how you got into the investment business.
Yeah, I'd love to give you a little background, and I apologize in advance. I don't do short well, but I will try here and there to try not be too loquacious. But I think my background is interesting in that my life's been a series of happy accidents, in the sense that I didn't plan originally to go into investing. Grew up in the West Coast, went to school at University of Notre Dame in the Midwest, and I thought I wanted to be a physician, of all things. And only in hindsight did I realize that science training, biology, chemistry, and physics, things like that, are actually really good training for investments. And we could talk about that at some point. But I went to be a doctor, decided very late not to be a doctor, went straight out of undergrad to business school at University of Chicago, got all my finance and accounting training, and then took the first job that was offered, working for an insurance company. And my first happy accident was the guy who was doing investments retired after about 9 months. And my boss, the CFO, said, hey, let's take over the portfolio. So I learned about fixed income investing, really exciting stuff. I always like to say I hired Dan Fuss before he was famous, very famous manager at Loomis Sales. We did about 2/3 of the portfolio outside, hiring managers, and about 1/3 of the portfolio in-house, basically building laddered portfolios. And it was the first time I got a sense of what it took to interview managers. I'm sure we'll talk about that at some point. But then my second happy accident was after a couple of years, a good friend of mine introduced me to two professors at Northwestern University. They had set up the first kind of quant shop. This was pre-computers, pre-PCs, and they were using the VAX computer at Northwestern in the evenings to run computer screens. And they were literally the first customer of CompuStat. They got the tape before anybody else. So they had a 4-day lead because of snail mail back then. Mm-hmm. And we ran low price to book screens back when that was really all there was to value investing. And they raised $1 billion back when $1 billion was a lot of money for a investment manager. And I was working there, learning the equity business, when I got the call. And what do I mean by that? Well, when Lou Holtz was the football coach at University of Minnesota, he had a lifetime contract unless Notre Dame called. Notre Dame called. He went to Notre Dame, had a great career. And I probably would have worked for these two professors forever. We had a nice business. There were only 5 of us. And the young guys really didn't make very much money, but the old guys eventually would pass them on, I guess. But I really wanted to go back to the alma mater. So I went back to the alma mater. And the big epiphany for me, I thought investing was just about picking stocks and bonds. And when I got to Notre Dame, after about 9 months, it became very clear that investing, at least in my opinion, was really all about asset allocation. Something that people don't spend as much time on, but what really drove returns was whether you were in stocks or bonds, whether you were in international or domestic, whether you were in real estate or private equity or venture capital. And I was very fortunate in the sense that there were two of us at Notre Dame at the time, and Scott Malpass is still there, great guy. I was the number two, always going to be number two. But because there were just two of us and we were just learning the portfolio, we got to do a lot of things. And we got some exposure early to some really great investments around venture capital, around international equities, around some international buyouts. And, we just had a lot of free reign because we had great leadership at the board level to truly focus on these big picture asset allocation moves. And then to speed up the story, after 5 years doing that, I got a call from a recruiter. The recruiter said there was a job in North Carolina. My wife said, take it. I said, don't you want to know what it is? She said, no, I just want to live in North Carolina. And she's from Oklahoma. She was tired of being cold all the time. So we moved down to North Carolina. And the great thing about moving to North Carolina, again, about this theme of asset allocation in my life and career, was North Carolina at the time was one of the worst performing endowments in the country, 84th percentile. And it wasn't because they didn't have good board members. They did. It wasn't because they didn't have access to resources and information. They did. The problem was their portfolio was very simple. It was stocks, bonds, and cash. And the board tried to time the market. Turns out they weren't that great at that part, but there was no diversification. They didn't look like Yale, Princeton, Stanford, Harvard, all these great endowments that had other assets like venture capital and buyouts and energy and natural resources and commodities and hedge funds. And so we went on a program of diversifying the portfolio. So I built a team and again, spent a lot of time focused on big picture asset allocation, getting that right. Secondly, making sure we got manager selection right. And then third, getting portfolio construction right, how much we gave to each manager, to me, I think is one of the most overlooked parts of investing. And then, we let the managers focus on security selection, which if you look at the academic research is only, 15+% of return attribution. So I use a basketball analogy for the early days at North Carolina. It's a basketball school. My first year, it was all reverse tomahawk slam dunks. Everything we did looked smart. Second year, layups. Third year, free throws. Not until the fourth year did I even take a jump shot. And in the fifth year, maybe a couple of three-pointers where we had to stretch and do some interesting, novel things to look good. But we turned the portfolio around. We got up into the league tables with the big boys like Yale and Notre Dame and Duke. And that was the really important thing. We had to beat Duke every year, not necessarily in basketball or football, but in investing. So that was really important to people. So maybe I'll stop there for a second before I get to Morgan Creek and see if that raises any other questions.
Sure. And there's a lot we could get into with your answers. I guess I could start by the very first thing that you alluded to, which was your science training and why you think that is important for people in the investment business.
Yeah, it's really interesting because I came to it not a priori, but ex post, in the sense that when you're doing science training, you're basically forming hypothesis, you're testing hypothesis, you're gathering information, you're reforming hypothesis, and that's how you do experimentation. And when you think about investing, that's exactly what investing is, right? We all form a hypothesis. We think stocks are going up, we think stocks are going down, we think interest rates are going up, we think interest rates are going down. We think venture capital company is really interesting, or we think it's not. And so we form these hypotheses, we make investment decisions, but then we have to gather data to decide whether things are working or not working. And if they aren't working, then we have to reformulate our hypothesis and start the whole process again. So the whole scientific method is interesting. And there are other things, like I'm a chemistry guy. I was chemistry and biology major, and particularly chemistry, I talk a lot about the rate limiting factor, right? Things can only happen so quickly as the factor or the product that's in least supply in a reaction. And I think the same thing is true in markets. If there's not enough liquidity to fund real estate development, real estate won't develop very quickly. If there's not enough innovation around new ideas in technology, then innovation won't evolve as rapidly. So it's these rate limiting factors that I think, again, are another example understanding science and thinking about science. And then the last thing for me is really something that I've embraced a lot in my career, which is this idea of innovation as an asset class. If I think about all the big fortunes that I'm thinking of, not the inherited kind, but the people who create their fortunes, comes from innovation, whether it's technological innovation or healthcare innovation or commodity processing innovation. All these things go back to, at the beginning, I think people overthink investing. To me, there's four things you can own: stocks, bonds, currencies, and commodities. Those are the four assets. Everything else is a derivative of that. For example, real estate is not an asset class, it's an access class. You either own equity of the deal, the debt of the deal, or the land, the commodity. Hedge funds, just a legal structure. You own stocks, bonds, currencies, or commodities in the hedge fund. I guess you could own derivatives, which derive their value from a stock, a bond, a currency, or a commodity. Private equity, same thing. You own common stock, preferred stock, or a convertible bond in a company. The only difference is a private company is a public company. And so all of this kind of wraps back around this idea that hypothesis formation and testing, gathering data, changing your hypothesis, but then also focusing on innovation to make the really big returns, particularly in venture capital and technology investing in the public markets. So those things have come with me throughout the years, and they lead me to kind of some of the stuff I'm sure we'll talk about later when you get into things like innovation in computing and the computer cycle and what eventually has led to cryptocurrencies and blockchain technology, things like that.
Mm-hmm. So you cut your teeth at Notre Dame and North Carolina, and maybe we can get into what were some of the lessons that you learned from those two places that you took with you when you founded Morgan Creek. Maybe we can start there.
No, it's really, really important question. And when you think about this model of investing, people talk about it as the endowment model. And I don't know if it's truly just the endowment model. I mean, wealthy families have been investing this way for a long time, and some institutions think about things this way. But, David Swensen gets a lot of credit he wrote the book about it. But as I said, I think a lot of families were practicing this a long time before it became popularized as the endowment model. But it has to do with this idea that if you think about the advantages that you have as an investor, what I like to refer to as edge. Where do you get an edge? Well, you can get an edge from better systems. You can have a better computer system or better processing system. You can get an edge from, in the old days, it was all about information access. You had access to information before other people. Either you had better relationships or you had, faster access to news or whatever it was. Or you cheated, right? Inside trading. But you had access to information, so you could get an edge that way. You could get an edge now from having a better computer model or a better quant system, or you could get an edge because you have domain expertise. If you're a scientist, for example, maybe you're a good technologist and you have good insight into technology investing. But whatever that edge was, it created an advantage. And there was another edge that endowments, foundations, and multi-generational families had, and that was an ability to do time arbitrage. So most investors, particularly individuals, we all have a finite life. I say we're working on biotech investing to change that, but for right now, we all have a finite life. So it means we're going to need to have access to our capital at some point. And so we will essentially pay a premium for liquidity. So very liquid assets tend to have lower returns. Illiquid assets tend to have this illiquidity premium that is then paid for by people who have a liquidity preference. And so endowments figured out that by moving a substantial portion of their portfolio into these illiquid assets, and I always say, it could be private equity, private real estate, private energy, private debt, any private strategy. And if you look at the best performing funds over the years, that's what they shared in common. So as I, again, had these realizations in working at both Notre Dame and building that portfolio, particularly we made a lot of money in venture capital, and then coming to North Carolina and realizing we'd made a lot of money, particularly from 2000 to 2002 in hedge funds. And I said, hedge funds aren't a thing. They're a strategy where you get exposure to stocks, bonds, currencies, and commodities. But one thing you can do in hedge funds is, again, you can take a time arbitrage because you can do both longs and shorts. So you can use short selling to finance better longs where you can hold them over longer periods of time. And so by using these alternative strategies, I don't like the term alternative investments. I always say whoever thought of that term was not a marketing genius, right? Because people don't like alternative stuff. They like traditional stuff. They don't like alternative medicine or alternative music or alternative education. They want their traditional stuff. So I like to think of it as alternative thinking. We need to think a little bit differently about how we invest. So when we formed Morgan Creek back in 2004, so in fact, it's funny we're talking today, this is our 15th anniversary of Morgan Creek. So I finished up, thank you. So I finished up, June 30th back in 2004, and I took a couple weeks at the beach, and then I started that second week of July, kind of, where we are. So I'm down at the beach now, kind of recreating that experience 15 years ago. And what was interesting is I wanted to bring this idea of alternative thinking about investing or this endowment model to other investors. So smaller families, individuals, high net worth, or other investors, as well as small institutions that didn't have staff. One of the benefits of these bigger institutions, or again, multi-generational wealth families, is they build teams, right? They have teams that actually do manager selection and portfolio construction, and they go around and they build an edge in either domain expertise or in relationships. They get access to better deal flow or better opportunities. Like at Notre Dame, we had really great access in venture capital. And back in 96, during one of the innovation waves around the internet, we invested a little bit of money with this firm called Sequoia, back when Sequoia really wasn't a famous venture capital fund. Mm-hmm. They put a little bit of money in this company called Google that, again, wasn't famous at the time. It was the number 21 search engine. But, the $500,000 we put in to Google turned out to be worth $200 million. So there should be a quad at Notre Dame called the Google Quad. And then at North Carolina, we had an edge in getting hedged with a D during the downturn from 2000 to 2002. And it's really kind of a funny story because in 1999, I'd been there about a year and a half, and markets were really cranking and started getting nervous about valuations, particularly in the first quarter of 2000. And I go to the board and said, I want to invest in hedge funds to get some risk management into the portfolio. And the board chair says, well, that's going to be tough because, we banned hedge funds 2 years ago. I said, all right, fine. We won't have any hedge funds. We'll have long, short equity, opportunistic equity, absolute return, and enhanced fixed income. And the chancellor of the university says, well, that's just nomenclature, right? And I said, yeah. He says, good, as long as we're clear. So, we put 60% into these hedged strategies, but we never called them hedge funds. But it was always about getting some edge. And so when we formed Morgan Creek, the idea was to help people gain an edge, either through relationships. And one area where we found that we had a lot of edge, I know something you and I had talked about talking about, is this idea that we believe investing with managers early on is a really big advantage. And so 70% of the investments we've made over time have been in funds 1, 2, and 3 in the private side, or in emerging managers, particularly in the hedge fund space.
Okay. So first thing I wanted to ask you is, you talked about the endowment model, and I had David Salem this week of New Province. He was kind enough to speak to us, and he talks about the fact that it may be dangerous for some investors to try to replicate the Yale model, which then became the endowment model, as it's more of a way of thinking and a thought process that David Swenson has perfected over the years, and it's not as easy to replicate. I just reading a couple of rules of thumb. So what's your opinion of the endowment model and how popular it has become?
Look, I completely agree that there are some potential drawbacks or barriers to, really perfectly replicating the model. Now, one of them is just staff and team and time. In order to get the type of returns that the Yales and the Notre Dames and the Dukes, the Stanfords, and David and his organizations over the years have gotten, is you really do have to do the work, right? People say there are 10,000 hedge funds. Now I joke, no, there's really 40,000. Because we've met all 10,000. They're all in the top quartile. So somewhere there's 30,000 bad ones. But no one's ever met a bad manager, right? Every manager comes in and they sound great. And Howard Marks has a great line, these guys, because you meet the marketing person. And the marketing people always sound good, because if they didn't sound good, they wouldn't let them out to go marketing. So your job as a picker of managers is to separate people who are good from the people who sound good. And that's really tough unless you do a lot of meetings. So one of the barriers to entry is just time and attention and effort. I'll give you an example. So we had a family that we met with right when we started Morgan Creek back in 2004, and they had made 17 private equity investments in kind of 2000. So I'll describe the process and you tell me which was the greater sin. So they met with 35 firms. So was that a bad sin because they thought that's all there was in the market that year? There were actually 450 in the market. All 35 they met with were from the tech industry because tech was hot back in 99, 2000. So that was the easiest thing to sell. And that's what Credit Suisse and Merrill Lynch brought this family to see. Or was the worst sin that they did more than half of what they saw? Or just around half. So they had 17 out of the 35. So, we try to do between 1% and 3% of the things that we see. We try to be diversified across sectors and industries. And clearly, if there were 450 funds in the market, the likelihood that you saw all the best ones, you saw 35, is really low. So I'm not sure I could pick which is the worst sin, but that's part of the problem. So that's a long way of saying one of the challenges to the endowment model is just time and attention and effort. Second thing is, as I said, the thing that really separates the best endowments from the rest is they have big allocations to private. Yale's at 58% private. Most of our clients are low 50s% private. And private investing is great, and it does work better in the sense that you get a illiquidity premium. The problem is, picture a chart moving from left to right. On the left-hand side is fixed income. On the right-hand side is venture capital. And think of floating bars for each asset class. And the top of the bar being the best performing manager, the bottom of the bar being the worst performing manager. If you look on the far left-hand side, the bar for fixed income, very tiny. What separates the top quartile fixed income manager from the bottom quartile fixed income manager is maybe 40 or 50 basis points. Now, I say, everyone calls themselves the bond king. None of them are the bond king. They're all the same. And I say people should spend zero time thinking about picking bond managers. Just pick one. They're all the same. Don't waste any of your brain cells trying to separate the top from the bottom, because there's no difference. If you go over to equities, moving to the right in terms of volatility and dispersion, in equities, particularly large cap, again, maybe 150 or 200 basis points. So spend a little bit of time there. Small cap, maybe 250 to 300 basis points. Spend a little bit of time there. And you start to move into private investments. In buyouts, separation could be 500 or 600 basis points between top quartile and bottom quartile. So now you want to spend more time. Hedge funds, 500 or 600 basis points. Where it really gets crazy is on the far right. If you think about venture capital, you could have 2,000 basis points between the top and the bottom. And the problem is the bottom quartile in venture capital have negative returns. So part of the challenge of replicating the endowment model is getting access to the top quartile venture capital funds. Most of them won't take yours or my money. They'll take the big endowments, but they really are very picky about who they want to work with. And so access really does make perfect replication of the endowment model tough. Now, I can argue maybe a little more vociferously than David might that you can find some assets that are pretty good proxies for early stage venture capital, but it takes a lot of work and it's hard, and you got to find small and micro cap managers, particularly in the tech side or the biotech or the healthcare side, and you've got to be willing to ride through the volatility because they are volatile, but their long-term returns are really, really good. So I'll say that there are access issues, and part of them are structural in the sense that the SEC says unless you're rich, you're not smart. So they say you've got to have a minimum net worth in order to invest in alternative investments. I think that's silly, and I hope Jay Clayton has made noises about changing that, and I hope he does, because I think everybody should have access to the best performing strategies and assets.
That's a good point that you touched on. The access is one thing. And the second thing is, I think, is the capacity of a strategy. If you are a large endowment and, your average ticket size is, $500 million, there might not be enough top quartile venture capital funds out there for you to put your money to work. So then the question is, how much time do you as a team spend looking at or trying to get access to these managers if you know that?
No, Leonardo, you make a really good point here, which is it's interesting. There is a sweet spot of opportunity. And this is one where I probably differ both from David Swenson and David Salem a little bit in the sense that I do think a small investor has some advantage in that once you get too big, and what's too big? Let's say right around 25 billion and up, you start to need too much capacity in particular strategies, particularly in early stage venture, and you can't even think about dropping down into micro VCs or super angels, which is an area we can talk about that I think is really compelling and interesting. But if you think about the big pension funds, the 100 billion, 200 billion, or the $1 trillion sovereign wealth funds, they really can't replicate the amount of exposure to innovation and to illiquidity that some of the mid-sized kind of 5 to 8 to 10 to 20 billion. But if you are, few million or 100 million or a couple billion, I actually think you have an advantage. Now, it is hard work. It's hard work to get access. It's hard work to find the name brands before they become name brands. I said one of the things that we've prided ourselves on over the years is investing in funds 1, 2, and 3. So, I said we invested in Sequoia and Kleiner before they were Sequoia and Kleiner, before they were household names. Mm-hmm. Now that Kleiner Perkins is on fund, 19 or 20 or whatever they're on, even if we could invest, we wouldn't invest because we want to invest in the people who are spinning out of a Kleiner or spinning out of a Sequoia or spinning out of some of the bigger funds. And we want to back the younger entrepreneurs because there's also a lot of great evidence, both anecdotal and actual statistical, that shows that there's also a life cycle to investing. While one of the things I love about investing is the older you get, the more wisdom you have and the more mistakes you've made. You've learned from those mistakes and you actually get better in terms of having investment judgment. But there is a sweet spot in people's careers, particularly in venture capital and other certain areas around innovation, where there's a life cycle of people haven't become so wealthy that they check out to go manage their own money, or like I say, they call in rich. And so we have found that, I'll give you examples. I won't name names. There was a venture capital manager I was talking to back in the previous boom around 2000, and they were starting to cut back investors in their fund. And I said, what's going on? We've been there since the beginning. What do you mean you're cutting us back? And he said, look, I can manage your money and get 30% of the profits, or I can manage my own money and get 100% of the profits. And I said, whoa, okay, I get that. But remember, you didn't have any money before we gave you our money to manage. We meaning all of us institutions. So they made us very wealthy, and I'm not complaining about that. And they took their cut. I'm not complaining about that. I did complain a little bit about them crowding us out with their own wealth, but I don't begrudge them because that's their prerogative. So then you have to go find the new managers or the new areas. And that's another great point here too, is that there are certain investors that as they become successful, they get entrenched in a certain area and they gather so much capital that then they can't go out and be innovative like they were in their early days. And so, there are a lot of examples of that, take around about blockchain technology today. There are a lot of marquee name firms that have been hesitant to go in there because it was such a lightning rod. They didn't want to make their institutional investors unhappy by doing something that was maybe, less tried and true. But it's kind of funny when you think back to 1996, when they were doing the same thing in the internet, when Paul Krugman said it would never be more important than a fax machine. So, things change.
Yeah. You touch on an interesting point, and that is the amount of money that managers put in their own strategy. And I mean, we speak about alignment of interest and skin in the game all the time in our industry. So my question to you is, how much is too much? At what point does skin in the game start becoming detrimental to the amount of risk that a manager is supposed to take?
Look, that is one of the best questions or best insights I've ever had a host talk about in doing one of these podcasts. Nobody talks about this. It is unbelievable how people are so axiomatic or dogmatic about this, saying, oh, I want the managers all their money in. No, you don't. Absolutely you don't. Because what's really interesting is you said it, right? Is their risk tolerance changes. If somebody has a little bit of money, but it's a lot of money to them. So let's say they haven't made it big yet, and they're putting either all their net worth or even more than their net worth because they're actually borrowing in form of reinvesting fees to go side by side. That's perfect alignment. Everybody is going to win if we all win together. And if it fails, then they just go start something else. They're still young. But as people get older and more successful, if they put too much of their capital in the fund, they're going to become less risk tolerant and they're going to lower the risk. And it's subconscious. They don't come out and say, oh, I'm going to take less risk now. But subconsciously, they're worried about losing money. We've all seen this in sports. How many times have you seen a team get a big lead in a game and then go into prevent defense? Right? They start playing not to lose. And what happens? I would say the prevent defense just prevents you from winning because the other team comes back because they're still trying hard. And so I think some amount of money invested is alignment, but too much capital actually leads to bad risk decisions. And here's an interesting thing, and you're seeing this a lot because people talk a lot about volatility as risk, and they're like, no, volatility is not risk. Risk is absolute loss of capital. Volatility is your friend. You actually want volatility. In fact, take this to the illogical extreme. If you say that I want to lower volatility and get rid of volatility, well, great, you're going to own T-bills. T-bills are the worst possible investment you could ever have over the long term. Over short term, they can be good. Cash can be good over a short term. But long term, you can have zero volatility, quote unquote, no risk, but inflation chews up your return and you'll get less wealthy every single day. Mm-hmm. So minimizing volatility should not be the objective. What it should be is managing volatility, but we should all seek volatile assets, seek risky assets in proportion to our own risk tolerances and our own desire to not make bad decisions. Because what volatility does is it forces human beings to make bad decisions at exactly the wrong time. So we tend to sell at the bottom and we tend to buy at the top. So we tend to get enamored of upside volatility and we buy into it. I'll argue that's what's happened in the U.S. market today. And then we tend to avoid the stuff that has just gone on sale. In fact, I joke all the time, invest in the only business I know where when things go on sale, people run out of the store.
Yeah, that's interesting. I mean, you talked about investing in first, second, and third funds, first-time managers. What's your process like? What is it that you look for when you're meeting with a 20 to 30-year-old that has never really managed their own money before and come to you asking for huge amounts of money? What is it that you're trying to gather from them in a first meeting, let's say?
We could spend so many hours talking about this because to me, it's exactly what investing is all about, particularly when you're an allocator of capital as opposed to just picking securities. And my belief system says that you make the most money from getting asset allocation right, you make the second most money from getting manager selection right, and then portfolio construction is really where you should spend all your time. So when you think about picking investment managers to allocate capital to, it is pretty complex. And you're right. A lot of times you're talking about very young people that you're now going to entrust. And why do you pick one over the other? I think it's an interesting dynamic, at least for me over time, is I look for a certain set of characteristics. And part of this just comes from, I get back to the science training. It's like you have a hypothesis on what you think will make somebody successful. And you hire somebody who has those characteristics. And then you get evidence that you were either right or you were wrong. Now, Michael Mauboussin would say, well, how do you separate between luck and skill? So there's 2x2 matrix. There's the quality of your decision. So what was your process and how did you make the decision? Was it a good quality decision or bad quality decision? And then what was the quality of your outcome, good or bad? Now, the worst possible thing that could ever happen to you is you make a bad decision. Right? You make a decision for all the wrong reasons, right? Somebody is hot, they get a lot of press or a lot of media, or a lot of people like them, or they had a big win in a previous fund or previous company, and now they're spinning out on their own. But you don't really do any diligence, you don't really do any work, but you just go with the bad decision process, and yet they have a good outcome. The most dangerous thing is like going to Vegas and winning your first time. Then you think it's you, and you think the odds are in your favor when they're not. And so for me, process comes down to a number of things. So the number one thing for me, and this is a personal thing, is I'm looking for competitive drive and what I call a fast motor. And I would say you know it when you're with it, right? When you're with somebody who thinks quickly, articulates clearly, not a lot of ums and uhs, they have the ability to really think deeply and critically about ideas and make them sound simple. That's what I'm really looking for. And I look for competitiveness. I love people who are super competitive. I love people, I like to talk about history. I like to know where people grew up. I like to know, where they went to school, why they went to school, where they went, what sports they played, and how competitive they are about that. I love people who are particularly good at a particular thing, like, scratch golfers or, ace tennis players. So competitiveness is important. And then I always say intellect, you need to be smart enough. Because I've actually found that the really, really, really smart sometimes can be too smart by half, and they can get themselves in trouble. And there are lots of examples of that over time. So I like people who are intelligent, but more intellectually curious than just book smart. I like people who love to learn and are always trying new things. But then on top of that, I think for me, maybe the most important thing is people of integrity and character. And it's like if you're playing golf with somebody and they improve their lie or they kick the ball, if they cheat on golf, they'll cheat on you when it's important, right? And when it comes time to mark an asset, they will mark it in their favor. And it's like I say, if people cheat on their relationship, they'll cheat on you. If they cheat at a game, at cards or whatever, they'll cheat on you. So people of integrity, critically important. And then I also think there's what I call big E entrepreneurs and little E entrepreneurs. I like finding big E entrepreneurs, but that's really not my forte. I like to find little E entrepreneurs that go out and find the big E entrepreneurs. And the big E entrepreneurs are people who invent new things or invent new businesses or new concepts. Little E entrepreneurs are people who like to build things, build organizations, build processes. And the best managers I've ever allocated to are these little E entrepreneurs. They have great internal processes. They have great teams. They have great rules for investing, and they don't deviate from those rules. And they may miss opportunities that are really hot, but they don't make those mistakes. This goes back to my very first bosses, those two professors at Northwestern. They had these brown coffee mugs, and on the coffee mug it said, "Invest without emotion." And it was all about having these processes and these rules and sticking to them and being disciplined. So discipline is something that I look for. And if you think about how most people pick managers or how most people make investment decisions, I say they do it upside down. There are the 4 Ps, right? There's people, philosophy, process, and performance. Most people do it exactly the wrong way. They look at performance and they chase the hot dot. So they're constantly buying at the top, and then they sell at the bottom, right? In fact, what you should probably do, and not probably you should do, is you should find people who have great long-term track records who just had a really tough period because they're going to mean revert back to normal. And that's how you should pick managers instead of chasing the hot 3-year number. So that'll give you bad performance every time. But most people look at performance first, then maybe they spend a little bit of time doing diligence on process and philosophy, and they don't really spend enough time with people. We invert it, and we focus on people first, people second, people third. Then we think about philosophy, process, and we think performance is a symptom. In fact, I like to go into meetings not knowing how someone's performed, and I like to learn about the person, learn about their background, learn about what drives them, what motivates them. And then after I've heard their story of their philosophy and their process, then I look at the numbers. Because if someone tells you they're a value manager, and they've done well in the last 5 years, they're lying, right? Because value has gotten crushed. It's at its worst performance ever. So people say they're a value manager. Well, they're not. I was with the guy the other day, he's trying to tell me how Amazon is a value stock. Like, please stop. Crazy.
This is the end of the first part of a two-part interview I had with Mark Yusko. If you like the conversation, I'd encourage you to come back in a couple weeks and listen to the second part. And if you're listening to this at some point in the future, you can just click on the very next episode and you'll be able to listen to the rest of our conversation.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.